Hello guys, this is Lee with our very first episode or video or segment, whatever you want to call it, of CMP, which stands for Credit, Money, and Power. What we're going to do in this channel is we're going to talk about different aspects of money, how credit works, how to fix your own credit, tips on that, and how to build your credit, how to talk about real estate, finances, investing, stocks, anything dealing with money and how to make money, different ways to make money, we're going to talk about it. And so I thank y'all for joining me on this journey. Let's get it started. Hey guys, I'm back. So I want to start our very first video with something that's going to be very basic, okay? And a lot of stuff is information that a lot of people just don't know. I want to break down how credit is actually calculated and how credit actually works when it comes to coming up with a person's credit score. So, first off, just to give you a little bit background, since it is my very first video, I came from a small town. I was a poor kid, came from a small town out of Freeport, Texas. I graduated high school in 2009 and then went off into the military. Went off to the military, I did my 4 years, and then I ended up getting a bachelor's degree in business management. Then I also got a master's degree in business with a concentration in finance. So I do have a little bit of knowledge and a little bit of background about money. I also used to work for Merrill Lynch as well, Bank of America, as an advisor and as an advisor apprentice. So I understand how money works, how the stock market works, and while we're going on this journey, I'm going to be learning new things, and as I learn new things, I'm going to pass that knowledge down to you, which is the knowledge that unfortunately they don't want us to know as the everyday person. So first things first, how credit works. Your credit is calculated within 5 different categories, okay? Payment history, credit utilization, number of new accounts, diversity of credit, and your credit history itself. So first off, what is a credit score? A credit score is pretty much a report card, financial and responsibility report card for adults. Once you hit 18 is when you get that report card, and a lot of people start off at 0. So you have 3 different main scores for 3 different main bureaus. There's tons of bureaus out there, credit bureaus and credit reporting agencies. But the 3 main ones that banks use are Experian, Equifax, and TransUnion. So just like anything in life, the more positive you have on something is going to be obviously making yourself go up. The more negative makes your stuff go down. So what I mean by positive and negative. Positive accounts are positive, open things that you either make monthly payments on or you finance through the bank, like a small loan or a secured credit card. Things that are negative, that affect your credit score negatively, that makes your scores go down, would be things like collections, charge-offs, evictions, repos, and things that the everyday adult has to deal with, unfortunately, because life happens, or some people are just irresponsible. But the main thing that is calculated on your credit report is payment history. So payment history is 35% of your credit score. 35%? Yes, 35%. So it's total, all 5 categories calculate into 100%. So 35% is payment history, okay? Payment history is how often, with the accounts that you have open, do you pay your bills on time, okay? So it's very important. The most important part of your credit is paying your bills on time, making sure that you do not have any late payments. You cannot let an account get past 30 days late, okay? Once it hits 30 days or higher, it will negatively report on your credit report. So as long as you can make that payment before the 30 days hits, you will be okay. Okay, it will report positive on your credit repair, or on your credit report, excuse me. Now, I'm not telling you don't go out there and not pay your bills on the due date. You want to make sure that you pay all of your bills on the due date. But if something happens, you have 30 days to make that payment to where it doesn't negatively affect your credit score. The next highest percentage of what makes up your credit is 30%, and that is your credit utilization. So if you have, let's say you have a credit card for $1,000, one credit card. If you max your credit card out to $1,000, you will be at 100% credit utilization, which is no bueno. You do not want to max your credit cards out, period. No matter who tells you that, it's a lie. Do not max your credit cards out. It negatively affects your credit score. Once you get to over, and it makes sense, right? So it's worth 30% of your credit score. So it only makes sense if you go over the 30% of what your credit limit is, that it negatively affects your credit. So you want to only use, this is what I recommend for all my customers that I do credit repair for, because I do have my own credit repair company. It's Barrel Bullies Credit Restoration. You can find us on YouTube. You can find us on Facebook, Instagram, Snapchat, blah, 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 right? So if you do need help with your credit, and as the videos keep going on, we do more and more videos, I will give credit repair tips. But if you need somebody to help you fix your credit, reach out to me or comment below. So the very trick to this that I tell all of my customers, you only want to use 10% of what your credit limit is. So go back to the example. If you have $1,000 credit card, you only want to use anywhere between $100 to maybe $150 worth of that credit card. Then you want to pay that credit card down to about a $5 to $10 balance before the statement date. And before you ask, what is the statement date? The statement date is before they report to the credit bureaus and they send off the statement to your house or to your app or wherever you get your statement at. So you want to make sure that you pay it down to a $5 or $10 balance, not to zero, to a $5 or $10 balance before your statement date. Okay, and you can call whatever credit card company or whoever you have your card or information through, you can call them and find out when the statement date is. You do not want to go over 30% of your credit utilization. And for that same example, 30% would be $300 of that $1,000 card. So any a dollar or penny, anything over that $300 mark would negatively affect your credit score. And the higher you max your card out, the higher it messes up your score. So the next category that is made up of your credit score, and the next highest one, is credit history. 15% of your credit score is made up of credit history. So your age of credit. Now, if you're 18 years old and you don't have a lot of credit, unless you're on maybe one of your parents or a family member's credit card or account that has a lot of history on it, your credit history is going to be very minimal, right? Even for adults that never decided to utilize their credit and they're just starting to build your credit, credit history is going to be based off the length and the average of the amount of accounts that you have. So you want to make sure that when you open an account, you want to try to keep that account open as long as you can, because that affects your credit history. Like I said, that's 15% of your credit score. Then the next critical category that makes up of your credit score is diversity of credit. Having a mixture of loans and a mixture of credit cards on your credit report will help your credit score increase as well. You want to have a mixture. You don't want to have a credit report of just loans, and you don't want to have a credit report of just credit cards. It's kind of like an investment portfolio. You don't want to have just stocks. You don't want to just have mutual funds, or you just don't want to have ETFs. You want to have a diversity of the mix of loans and credit cards and different type of things like that. The last thing that makes up 10% of your credit score, which is a total of 100%, is new accounts or open accounts. Okay, that affects your credit score by 10%. Sometimes opening new accounts can positively affect your credit, and sometimes opening new accounts can negatively affect your credit. It depends on what you already have established on your credit report is what comes to how that affects your credit. So new accounts, 10% of your credit score, and that makes up a total of 100. So that's some free game for y'all. We got a lot more to come in the future. We plan on putting out a new video once a week, at least once a week, to give y'all credit repair tips, like I said, to give y'all more financial advice. We're talking about investments. I even plan on having guests to talk about their specific professions and how they can help you become more successful and more financially, stable and free in your life. And shoot, it might even be able to help me. So look forward for new content at least once a week. Hit the like button before you click out this video. Make sure you hit subscribe. And thank y'all so much for your time and giving me that love on the very first video. Y'all have a good day, and I'll see you soon.